Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. This week I'm going to show you a little something that you can do with your moving average lines. This is a principle that was brought to my attention by Rob Tavel from On Course Trading. It's Rob and I, we actually trade in a very similar fashion, but this is one thing about moving average lines that I didn't really consider until Rob mentioned it, and it's a very valid point, and I'm going to share it with you today. I want to point out that this is something that works in all time frames, so you day traders might want to incorporate this as well. It actually works quite well for day trading as well. A lot of times I will run just a single moving average line on my chart. I tend to use a longer moving average line like a 55 or perhaps a 60, and if the market is above my moving average line, I consider it to be bullish, and below the moving average line, I consider the market to be bearish. Just a very simplified indicator to tell you what the market is doing. You can also look at the moving average line itself. If the moving average line is moving down, well, of course, the market is bearish. If the moving average line is moving sideways, and you'll be surprised how often this happens if you look for it, you'll know the market is neutral and it's a good time to avoid it. And then, of course, if the moving average line is moving higher, the market is bullish and we should be looking to buy. I also like to put a second moving average line on the chart on occasion. And my line of preference, and actually coincidentally Rob's line of preference, is also the 20 moving average line, the 20 period moving average line. This works great on a daily basis, but it has merits for an intraday basis as well. From a daily point of view, there's 20 trading days in a month, so the 20 period moving average line roughly represents the monthly trend. You can see it's a little bit more responsive. It follows prices more closely. But here's the principle I want to share with you. When prices are below both lines, then that is the time to consider a trade. If prices are above both lines, that is a time to consider a trade. However, when prices are between the lines, as they are back here, or as they are here, or as they are right here, these are the times to avoid a trade. Now, on a daily chart, these regions are rarely as large as they will be on an intraday basis. Rob even coined the phrase abattoir, which is French for slaughterhouse, because that's where a lot of traders end up getting killed. Why? Well, simply because the market has no defined direction. When prices are trading in between the moving average lines, what is that telling you? If we changed this and put, say, a 5-period moving average on here as well, let me see if I can delete the... Okay, here's your chart without any bars on it, just your moving average lines, the turquoise being the 5-period, the 20 and the 55. Well, here it is in between your 20 and your 55. So what is that telling you? That's telling you you have a market that has no real direction to it. Here the market has direction. The 5 is below the 20 is below the 55. Prices are going down. Here, the market has direction. The 5 is above the 20 is above the 55. The market is moving up. And likewise here, we have direction. But here, what do we have here? We have nothing. We have a jumble of information. Now, I know there's different ways that you can trade these moving average lines and such, and we're not going to get into that into this lesson. But I just wanted to show you that when the market is trading between the moving average lines, that might be a time to avoid it. Let me eliminate one of these lines here so it gets less confusing. All right, so let's take a look here. What would happen if we had paid attention to that? All right, we would not have taken the signal anywhere through here because the market did not have any defined direction to it. So where do we next see support come into the market? Well, we see support right around here, don't we? With our red-green bar combination. And we would have had a buy signal and a nice little run ensue from there. What happens after that? Well, the market falls back down here. It's in between our moving average lines. So do we take this signal? Well, if we did, we would have got lucky. And actually, come to think of it, I think I did take this signal. But you can see that they won't always work out. And I'm going to point that out to you a little bit later. This signal is a higher risk signal than you would have gotten, say, off of the support signal up here, or certainly the support signal right through here. This would have been a much more predictable move. This is how you can judge which trades will be more risky and which trades will be less risky. Once again, the prices fall between the moving average lines, so you would avoid taking a trade anywhere through here. Your next support signal comes right here, and look at that, that's right at the beginning of the run. Sure, you didn't catch it way down here from the low, but who cares? You don't look to buy the lowest point or to sell the highest point. That's not feasible. You may do it from time to time, but you can't do it time and again. Okay, so you would have caught a nice little run here. Let's take a look at where prices are trading currently. Look at what happens here. Market comes down. It's between our moving average lines. Now, let's say the 20 was not on there. And I will back this up a little bit for the sake of the example. Okay, here we are. We're right off support. We have support. We have a support signal. Right? We have old support here. And we've got a support signal. We're right off of our 55. That is a buy signal for us. If we had put the 20 on here, we would say, no, this isn't a buy signal. The market is too uncertain. What would happen if we did buy it? Depending on where you actually placed your order and where the market opened, in this case, it very likely did not open high enough. But for the sake of the example, we'll say that you could have gotten brought in and whipsawed on a bad trade. And why? Because the market lacked direction. And in this particular instance, the market actually ended up going the other way. And so where are we now? Well, look, now we're in a position where the market has actually moved back into a more stable condition where the 20 is below the 55. Prices are below both moving average lines. So here we can start to look for opportunities to sell this market again. Okay, and look at what happened toward the end of the week. Well, where are we? We're right back in the thick of it. We're back into an unstable market. So, like I said, you can use this on an intraday basis or even for a position trade. But it's an interesting little interpretive tool that you can easily implement, and it will help qualify which trades are going to be better and which are going to be higher risk. And that's this week's Tricks of the Trade.